I'm Chang. This is the best of Bloomberg Technology, where we bring you all our top interviews from the week in tech. Coming up, Disney pulls the plug on Netflix and unveils plans in the pipeline to roll out family films on its own streaming service. CEO Bob Iger joins us to discuss the way forward for the House of Mouse. The memo nobody missed from Google, a male engineer's manifesto against the company's diversity initiative, has gone viral. The fallout from the 10-page rant that hit reset on Silicon Valley's diversity problem. And Lending Club could be shaking off its losing streak. CEO Scott Sanborn joins us to discuss the online borrowers' improving fortunes and a near-record earnings report in a Bloomberg exclusive. First, to our lead. Disney is once again shaking up the media industry, saying it will stop selling movies to Netflix and begin offering ESPN sports programming and some of its most popular family films directly to consumers via two new streaming services. The need for Disney to act was underscored by the company's fiscal third quarter financial results, which were also announced this week. Sales and profit fell due to weakness in the company's big cable TV division, especially ESPN, where subscribers and ad sales shrank. Bloomberg's David Weston sat down with Disney CEO Bob Iger and discussed the company's streaming plans, plus the outlook for the company as a whole.
We've seen a pretty dramatic shift in the way media is consumed. It's becoming more and more app-based. You just mentioned as it related to your 15-year-old son. I see it certainly with my kids and my grandkids. And a lot of the app-based consumption is done on over-the-top direct-to-consumer services. We've obviously got the great brands to be able to reach consumers directly because the brands are in demand and there's great passion for them. You need the technology to do that as well, and that's no easy task. It's not simple, particularly when it comes to streaming live sports where you have consumption at a very, very high level and it's all at once. So we bought a third of BAMTech a year ago. We had an option to buy control 4 years hence. We've accelerated our purchase of control so that we could move into the space at a faster pace, at a faster rate than we had initially anticipated because of the opportunity that we see in the marketplace. It's that simple. It's a combination of brands, technology, and consumer trends.
So talk about the consumer for a moment, because I know the Walt Disney Company and you personally really focus on the consumer experience. At least initially, who is the target audience? Who do you think will use most often either this ESPN over-the-top or the Disney/Pixar?
Well, you're looking obviously on the sports side at the sports fan and as the ESPN fan as well. Sports is still among the most popular programming that's out there. In fact, if you look at the 100 top rated TV shows in the United States last year, 94 were live sports. ESPN obviously provides a lot of live sports on its linear channels. This service will provide an additional 10,000 additional live sporting events in its first year of operation. So we're looking to reach the passionate sports viewer, this passionate sports fan that wants to be able to watch sports on mobile devices, on you describe as over-the-top direct-to-consumer services with really high-quality user interface. And essentially, that's what we're providing. On the Disney side, we've got a global fan base. They're passionate. There's a great affinity to the Disney and Pixar product. It's families, it's parents, it's kids, it's even teenagers and certainly grandparents. So we reach basically everyone, and it's worldwide. It's not just in the United States. There's a great thirst for a Disney-branded product today, and we're going to serve that fan well.
As you say, particularly live sports programming has really been a mainstay of television for some time, going all the way back to broadcast television, and certainly everyone knows with respect to cable. Because of that, the cable distributors have been really reliant upon ESPN first and foremost. What do you expect the reaction to be from the cable distributors?
Well, we're going to continue to distribute the ESPN linear channels through the cable distributors. They've been good partners of ours over the years, and together we've managed to create a highly profitable business. The distributors and the programmers alike have been experiencing the disruption that the whole market really is seeing and multiple businesses are seeing from advances in technology and changes of consumer behavior because of that, and we feel we have to react accordingly. My guess is that the distributors will look at this probably, more as a threat than anything else. It's not intended to be that. What we're doing is we're reacting to marketplace conditions, and we're taking advantage of the quality of our brand, the passion in the product that we create, and the technology that enables us to reach consumers directly. You look at Disney's businesses, by the way, except for the theme park business, virtually all of our businesses touch the consumer through third-party distributors. That's everything from big box retailers to owners of motion picture theaters, and I could go on and on. This is an opportunity for us to reach the consumer directly, and that's an important step for the company in terms of growth.
When a CEO like you makes a major strategic decision like this, they inevitably have to ask themselves, do I build it or do I buy it? Did you go through that process? Did you consider buying something, for example, like a Netflix? Why did you decide to build it rather than buy it?
Well, in a way, this is a buy as well. We're buying a technology platform that's enabling us to create these businesses and go into this space much faster than we would have had we built it. I'm not going to comment on whether we looked at Netflix or what other acquisition opportunities that we've looked at or have had. We obviously have the financial wherewithal to do a number of things, but this seemed to be the best step for not only the Walt Disney Company, but for our shareholders in terms of creating a growth strategy, really growing the company long-term, taking a long-term view, which is really important, but also addressing some of the near-term issues that we're seeing, which is all about the disruption created by digital technology.
In the sports app, the ESPN app, you have some major sports in there. You've got the NHL, you've got the MLB, the Major League Baseball, you've got college sports. I don't see NFL at this point. I don't see NBA. Are there plans to add those, and under what terms could you get them in?
Well, we intend to license sports specifically for this app beyond the sports that have already been licensed either by BAMTech, because they've been in the business of licensing, or by ESPN. This creates an opportunity for us to monetize in more effective ways through subscription revenue as well as through advertising revenue, and in all the ways that a direct-to-consumer relationship can generate revenue. And so I think you can expect that this product will be in the marketplace to license more aggressively from basically multiple sports organizations, possibly even including the NFL and the NBA, where we have great relationships.
I noticed in your release you said, and I'll quote here, that you plan to make significant investment in an annual slate of original movies, TV shows, short-form content for your Disney app. Are we talking about the sorts of investments we've seen from the likes of HBO, for example, or we've seen from Amazon, we've seen from Netflix?
Well, I think you've got to be careful there, because Netflix, I can't comment on what Amazon's been investing, but it's pretty widely known that Netflix has been investing billions of dollars in original content. They've done so very effectively. I think what you mentioned, when you mentioned HBO, maybe this is a little bit more akin to that. We're going to basically produce, we're already developing, original movies and original television series specifically for this Disney-branded service. And it will be incremental investment to the investments we've been making in television and motion pictures in the past.
That was Bloomberg's David Weston with Disney CEO Bob Iger. Well, Alibaba and Marriott are teaming up to tap into a Chinese tourism boom. The companies will set up a joint venture to feature Marriott's hotels on Alibaba's travel site. Marriott has 6,000 hotels, including the Sheraton and Ritz-Carlton chains. China is now the world's largest source of outbound travelers who've spent more than $100 billion in 2016, spurring changes across the global tourism industry. Coming up, a Google employee's anti-diversity screed enrages the company and Silicon Valley. This is Bloomberg.
Google has fired the male engineer who wrote a controversial memo about diversity efforts in the tech industry. James Damore authored an internal 10-page memo asserting that there are biological causes behind gender inequality. Now, Bloomberg's Emily Chang spoke with James Damore in a broadcast exclusive. She started by asking, well, if he had any regrets about releasing the memo.
It's hard to regret it just because I do believe that I'm trying to make Google and the world in general a better place by not confining us to our ideological echo chambers where only one side of the story can be heard and it's totally intolerant to other viewpoints and even scientific evidence.
What scientific evidence are you talking about? Because in the follow-up to your piece, there have been plenty of discussion about this, and discussion about the fact that there is no research to support this idea that there are biological causes for the lack of women in tech or the lack of women in leadership positions. I spoke to Megan Smith, who worked at Google, who was the former CTO for the United States, and she said that this is a myth.
Among psychologists, there's a consensus that prenatal testosterone does affect a lot of personality traits, and in particular, one's interest in people versus things. And I'm not saying that all men are different than all women, just that there's a distribution of these personality traits, and that distribution differs between men and women. And so there are very many capable women at Google, and I'm not trying to say that any of them are any worse than average male engineer at Google. Just, I was trying to address why we don't have equal representation from the population.
Susan Wojcicki wrote a very impassioned response to this, and she said that your memo, had it been about Black people or Latinos or the LGBT community, that you wouldn't have anyone defending you. How do you respond to that?
So I think that that's just a false analogy, and she's trying to lump me in with racists and other bigots, which I'm not. I'm not a sexist, and I'm not a racist. So I think that that's just trying to smear my image rather than actually looking at the evidence. Very little of the responses have been actually looking at the science. They've just been calling me names or nitpicks of, oh, the formatting was a little wrong, or the original leaked document that someone else leaked didn't have any citations when my original document did.
You're arguing for ideological diversity and ideological inclusion. Don't you think that extends to women and minorities and all kinds of people? Google is making products for the world. Don't you need to have all kinds of people making those products?
So, yes, I support diversity and inclusion. And I think that also our lack of ideological diversity has actually hurt our project or our products. And it makes us think that, for example, just the stereotype that all conservatives are stupid, for example, that is widely held within very left-leaning circles.
That was former Google engineer James Damore speaking exclusively to Bloomberg's Emily Chang. And Google CEO Sundar Pichai has also issued a statement. He says, "Our job is to build great products for users that make a difference in their lives. To suggest a group of our colleagues have traits that make them less biologically suited to that work is offensive and not okay." Joining now for a deeper look from San Francisco is Bloomberg Technology's Ellen Hewitt, who's been reporting on this story and diversity at large. And Ellen, talk to us about the town hall meeting that Sundar Pichai is going to be holding with all of Google later today. I mean, is this a rare occurrence, and what do you think he wants to achieve by it?
Well, the town hall meeting is the TGIF, which is a weekly Google meeting that usually took place on Fridays. That's why it's called TGIF, but they switched it to Thursdays a while ago. But it will be, I think, a hotly watched TGIF. I know, I've talked to sources within Google who are not in Mountain View, and they say they're going to dial in. They're really interested to hear what Sundar has to say about this memo. The CEO, he cut his vacation short in order to return in time to address the company about this. And ahead of time, you can see Googlers internally vote for questions that they want to be addressed at the meeting. And what it seems like they're very interested in is, how can we make sure that we make Google a place that feels comfortable for everyone? And then also, how can we make sure that it's a place where employees feel like they can express their views without getting fired, which is a concern that Mr. Damore had originally brought up in his memo.
Interesting. So do you think there might be some way sort of issuing an easing of concerns to those who might be of a conservative persuasion working in Google? Because it's not just been brought up by James Damore, but actually at the shareholder meeting back in, was it June or earlier this year, a shareholder brought up the fact that they felt perhaps conservatives aren't welcomed by Google.
Yeah, you know, if you talk to people who are supporters of James Damore, and, you know, he said the same thing in his memo and in interviews afterward, there's this idea that there's sort of a silent minority of conservatives who really don't feel safe speaking up about their political points of view because it's not really a commonly held belief at Google. And you're right, it totally has implications for how Google is viewed. And Silicon Valley, you know, very large, powerful Silicon Valley companies tend to lean left. And that has had effects in the way that they've, you know, had to deal with, you know, Facebook has had to deal with allegations that they suppress conservative content. You know, this extends a little bit farther than just this one engineer and his time at Google.
Well, Tesla is making its debut in the primary corporate bond market. This coming as Elon Musk bolsters his company's audacious bet on a more affordable electric car. The automaker plans to sell $1.5 billion of bonds to support spending on its new Model 3 electric car. The sale will also bolster its balance sheet. Tesla burned through a record $1.2 billion in cash in the second quarter. Coming up, Masayoshi Son on the hunt for more deals. We'll discuss what is next for the massive Vision Fund. Plus, highlights from our exclusive interview with French Finance Minister Bruno Le Maire, why he's promising a big change in the tax system across the EU, and what that could mean for tech giants doing business in that country. This is Bloomberg. Japanese tech giant SoftBank reported earnings this week. Sprint helped SoftBank beat estimates with an operating profit of $4.3 billion. That's good news for SoftBank's chairman and CEO Masayoshi Son, who's on the hunt for more deals and investments. The billionaire is in the process of creating the $100 billion Vision Fund to speed up investments in technology startups abroad. The fund was included in the results for the first time. Son says he's mulling various deal options, including a merger between Sprint and rival carrier T-Mobile. Our Bloomberg editor-at-large and Bob O'Donnell, president of Technalysis Research, joined us to explore Son's options.
I think that's exactly what we're seeing Masayoshi Son do. And he's talked about this for years. Ironically, I actually worked for a company that he bought about 25 years ago when he first started this vision of building up media. It was a small high-tech music magazine. But watching him over the years and seeing this vision evolve, he is driving himself to be sort of the tech version of a Warren Buffett in an interesting way. He's creating this conglomerate of all these component companies that he sees as being critically important to drive forward this vision into the future. And I think it's a smart plan. Now, not all the bets are going to work, but I think he's placing them in a lot of good places.
Corey, Masa-san, Warren Buffett of Asia, what do you make of that?
No. Come on, Bob, look, I mean,
come on.
Warren Buffett's Warren Buffett because he's proven himself to be a successful investor of buying things of low valuations and helping them grow in a sort of quiet way without using a lot of debt. This is the opposite of that. This is taking on enormous amounts of debt with tremendous risk on that debt. If you watch the way the CDOs traded in Sprint over the years, you've seen that investors have looked at this and thought he's near the edge of bankruptcy over and over again. These are big swings for the fences and anything but low valuation. As I said, meant using a lot of debt to do it. I think what's interesting here is he's also trying very much in a Buffett-like way to use politics and to use connections to try to make these deals happen. In particular, think of the image of Masayoshi Son in the Trump Tower visiting President-elect Trump, talking about all the jobs he's going to create with this investment fund that he'd already announced that President-elect Trump didn't seem to have heard about before, but wanted to let him get credit for it. At the same time, he's still thinking about the T-Mobile merger that the Obama administration had said was not going to be good for U.S. consumers. Son perhaps thinking that his appeal to President Trump in particular and his personal appeal might somehow get this deal through, and clearly still talking about this.
Bob, respond. I mean, look, there's a lot of question about whether he can pull off these deals. It's certainly very ambitious.
It is very ambitious. And look, and to be clear, I'm not saying he is a Warren Buffett. I'm saying his goal is to be like a Warren Buffett. But his approach is not
mine, by the way, if anyone's taking score,
Hey, me too.
But his approach isn't on value. His approach is on building and buying these core components. Like, people don't think about the fact that he owns ARM. ARM is this semiconductor IP company that has an incredible amount of influence that most people don't recognize and realize. He's got telecom, he's got internet, he's buying robotics. He's buying a lot of the core technologies that he thinks can drive forward. Now, admittedly, the debt is a big issue, clearly, but I think he's being smart and developing a vision. He has what he calls his 300-year plan. Now, obviously, that's a bit overkill, but even having a 25 or 30-year plan these days is a big deal, and I think he's making bets based on that vision.
Corey, we've been talking about a potential Sprint-T-Mobile merger now for years. How do you see this actually playing out?
Well, I think what I'm trying to get my head around is the notion of 5G and what 5G is going to mean, and how the landscape where we've got really more than half of the U.S. mobile phone market is between two companies that are virtually equal in market share, in AT&T and Verizon. So what's trying to do with AT&T and Verizon is what T-Mobile and Sprint are thinking about. And so, but when it comes to 5G, things can be very different in terms of who's got the spectrum and who doesn't, and that maybe there's a chance to sort of rewrite the market share pie chart that you're looking at right now in a world of 5G. But I think it's also worth noting the comments that Machios Son had this week, which is to say he wants to be number one, is not satisfied being number three. And by the way, look at the rearview mirror, number four is not too far behind. But I think as U.S. consumers, when we think about it in terms of how the government's looking at this, what he wants is to be number one. He doesn't want U.S. consumers to have the best choices. He doesn't want U.S. businesses to have the most options for providers of wireless services that will go far beyond just making calls or getting data. And so we have to think about what it means for what the business changes will be if we have fewer competitors in the U.S. providing a wireless service in a world of 5G, when so many technology businesses will be based on the availability of 5G. And if there are fewer competitors, we know that the prices are going to be higher. And so what's that going to mean for businesses and for consumers going forward? And is the Trump administration going to care about that when they take a look at this deal and might come up with a conclusion different than what the Obama administration saw?
Bob, this wouldn't be just another big tech deal. This is a deal that could impact directly hundreds of millions of customers.
It absolutely could. And clearly, he's going to need to get all of those pieces together, the Charter piece that you mentioned, as well as T-Mo and Sprint, to really be a viable competitor to those other two. And so that's a big question mark if he can really pull it off. I do think in the current administration, there's going to be less of the governmental pressure that you mentioned early on. So it may be that those things are brought to the side. But, you know, Corey raises some good points, right? There clearly are going to be challenges to the consumers, and other governmental entities may still step in on this and just say, no, this is too big to make this kind of a thing happen.
Corey, this is the first time we saw the impact from the $100 billion SoftBank Vision Fund. Of course, that's still being raised, but what did you see in the results in terms of any more indication about how this is going to be spent? I
mean, it's way too early to see what we're going to, with the results of running a venture fund under the arm, or under the umbrella of the much larger SoftBank. I mean, what we're going to start to see perhaps is some fees, but it depends on how they're going to recognize those from an accounting basis. But I think that, you know, if you look at the history of Sprint, you see a couple of bets that have paid off fantastically from a venture side of things, whether it was the investment in the game companies in Scandinavia or Alibaba in China or Yahoo Japan. You know, such great returns from those investments that you can see why he's got stars in his eyes and wants to pull that off again, whether it's managing money from other investors or money from Sprint itself.
Bloomberg's Corey Johnson and Technalysis Research President Bob O'Donnell. Coming up, an exclusive interview with Lending Club CEO Scott Sanborn on the company's latest earnings report, how the peer-to-peer lender was able to turn the corner after the surprise ousting of its former CEO. And a reminder, all episodes of Bloomberg Technology are now live streaming on Twitter. Check us out at Bloomberg Tech TV, weekdays 5 p.m. in New York, 2 p.m. in San Francisco. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Emily Chang. Shares of peer-to-peer online lender Lending Club surged the most in 2 years this week. This comes after the San Francisco-based company posted its second highest quarterly revenues in its history on Monday, seeing net revenue spike 35% year over year to $139 million. The improved figures come about a year after the now former CEO, Renaud Laplanche, was ousted after the board found problems with lending practices and his lack of disclosure surrounding a personal investment. Lending Club CEO Scott Sanborn joined us for an exclusive TV interview to discuss the future of the company.
Yeah, it's really been about investing in the foundation of the business and putting in the right controls and bringing investors back to the platform. A critical piece of that is banks, and we announced that in Q2, 44% of our funding came from banks providing capital to fund the loans on the platform.
When it comes to the scandal that you've now moved beyond, I mean, do you feel like the company is back in a good place?
Yeah,
is it completely behind?
I think both the results we delivered this quarter and what I just talked about is having our investors back on the platform are both clear signs that we are looking ahead.
So your main competition is credit card companies. No small opponent to take on. Where are you gaining the most ground?
So if you look at what's happening in the broader market right now, there's over $1 trillion in outstanding credit card debt. So more than half of Americans have had credit card debt in the last 12 months. What we're doing is saying, look, if you haven't paid off your credit card, you have a loan, and it's probably not a very good one. And in general, we make it very easy for them to save, on average, about 24% in interest versus that product. So that's really the core audience that we're going after.
This also suggests, though, that lending standards could be getting looser, right? I mean, where do you think we are in the credit cycle?
So,
because $100 trillion in outstanding credit card balances is as much as before the financial crisis.
It's actually higher, yeah. It's higher. So one of the powerful things about our model is we make all of the performance on our loans publicly available, so our investors can actually see for every loan we've ever issued, both over 100 credit attributes for that loan. So what does it look like from a credit perspective, but also what's the payment history. And what we are seeing, which we talked about, is we did see deterioration in credit performance about 18 months ago. We started talking about it. We took very swift action, and what we're seeing right now is stabilization in performance, and our loss rates and our, most importantly, forecasted returns for investors remain in line.
So when do you think we're going to start to see things turn? Will we start to see things turn?
So that's obviously pretty hard to predict. I think what you're hearing right now is in certain markets, the auto market is starting to see signs of deterioration, as is credit card. But on the flip side, you're still seeing a lot of things to like in the macro environment for consumers. Unemployment is very low, inflation remains low, oil prices remain low. Household formation is up, so these things are counterbalancing. I think the thing to watch here is consumers' ability to service the debt that they've accumulated. Right now, overall debt has moved away from mortgage, moves into student, auto, credit card. So that's the thing to watch.
What risks are you being vigilant of as you grow loan origination?
Yeah, so it is critically important for us to be good stewards of credit performance. We are aided in that not only by the data that we generate. We are the largest provider of personal loans. We've been doing this for 10 years, so we have a lot that we can see and compare. But we also have, last quarter, over 100 institutional investors purchased from us. They also have very sophisticated credit analysts looking at our data and giving us feedback. So the signs we're looking for are the consumers who appear to be accumulating debt and not actually doing what they intended, which is to pay down or pay off the debt that they took a loan from us to eliminate.
Your board includes John Mack, former Morgan Stanley CEO,
Correct.
Larry Summers, Mary Meeker, people who have weathered the financial crisis, weathered the dot-com bust. What are they telling you about risk?
It's an exceptional board. They've been incredibly useful to help guide the company and set the course forward. I think right now they're looking to the company to help illustrate what the risks are in the market and make sure we're executing prudently and deliberately. And important to note that our execution in Q2 is really about product experience and marketing experience. It's really not related to credit.
You launched your first securitization this quarter. How big a part of your funding mix?
So,
it was
so the loans that were contributed to the securitization were actually loans that had bought historically. So in terms of the overall funding mix, it remains a pretty small percent. But what it does do is introduce us to a whole new group of investors. We had over 20 new investors who participated who need to buy a rated asset. So that was great to see. And it showed a lot of demand for the Lending Club asset.
That was Lending Club CEO Scott Sanborn. Meantime, WeWork is continuing its global expansion, this time centering on Southeast Asia and South Korea. The world's largest provider of shared workspaces says it will invest $500 million in the region and will acquire SpaceMob, a Singapore-based co-working startup. This latest move comes on the heels of WeWork's announcements to expand into China, Japan, and a third WeLive location in Seattle. Bloomberg Tech's Selena Wang and Technalysis Research President Bob O'Donnell joined us to break down the deal.
The acquisition of SpaceMob is actually the first time WeWork has outright and acquired another type of co-working space. All of the previous acquisitions have been for related services. And so with this acquisition, which likely was not very large, they're getting a local team and people with local expertise. SpaceMob is based in Singapore. Now, the company says that they very much wanted to do this acquisition for the talent and that local expertise. And they've been expanding incredibly rapidly. And as you said earlier, they're really taking this approach where they're finding people who are already there, have the expertise, and finding investors together so they can rapidly scale in the region.
Now, I actually interviewed the head of SpaceMob at the end of last year before this acquisition happened. Take a listen to what he had to say.
Lines are blurring, especially when co-working is being offered to traditionally more entrepreneurs, more SMEs. But even the corporates are looking at co-working as well right now. This is a way for them essentially to save capex, a way for them to be flexible, a way for them to basically learn how to be nimble as small companies. So we are helping companies small to become big and big companies to remain small and nimble at the same time.
Bob, how optimistic are you about this co-working space trend? $20 billion.
It's impressive that they've gotten this far, but I have to tell you, I've done research on this, and there are a lot of concerns that people have once they've started to actually do this. Because what you find, for example, is they're very noisy environments, and it's hard to get work done in a lot of these places. So when I looked at trends of where people expected to be working over time, those WeWork type situations were growing, but then stalling. And that's the concern. And the other big concern is this has traditionally been a U.S. Business or tech-focused kind of attraction. In other words, you find a lot of U.S.-based tech companies working in these environments. Whether that can transfer culturally and into other industries remains to be seen.
Right. Tech startups aren't the only kinds of new businesses out there. Selena, how is WeWork addressing some of these concerns?
Well, WeWork has a very high valuation. As you said, they need to live up to that, and part of it is by rapidly expanding globally with partnerships with people with a lot of capital, like Honey Capital in China, SoftBank in Japan. Now, a lot of the concerns are that this is kind of a cyclical business. When tech and startups are doing well, WeWork is going to have a lot of business. So they've also made some changes in their strategy to incorporate more enterprises and large businesses like a Microsoft that wants some extra flexible working space. And so they're really trying to diversify their revenue streams not only globally, but also with their existing co-working strategy.
Bloomberg's Selena Wang there, as well as Technalysis Research President Bob O'Donnell. Well, Uber is said to plan on unloading its subprime car leasing program. According to people familiar with the matter, Exchange Leasing, a wholly owned subsidiary, is unsustainable and should be sold or consolidated into a smaller unit within Uber. Its 40,000 car fleet has an estimated loss of $9,000 per vehicle. Uber's board decided to wind down the program last month after realizing costs were much higher than originally thought. Coming up, Facebook is bolstering its efforts in combating hate speech. We'll dive into the tech giant's latest move and possible impact next. Plus, Netflix makes its first ever acquisition. We'll talk about why the streaming service sought a comic book publisher. This is Bloomberg. Facebook is doubling down on its efforts to combat hate speech. The social media giant said it's adding 500 content control staff in Germany. This comes amid pressure in the country to crack down on offensive posts, with Germany's parliamentary lower house recently passing legislation threatening fines of up to $59 million. That fine would be levied on large social networks that fail to let users report hate speech or to remove illegal postings. I caught up with Bloomberg's Caroline Hyde from London and Techonomy CEO David Kirkpatrick and started by asking what was behind the uptick in staff.
We've heard as recently as back as May, but then more recently in June, that we were going to see a beefing up across the world of content control people that were going to be working on behalf of Facebook. They said they were going to be expanding it by some 3,000 new content control staff to beef it up to be 7,500 worldwide. Now, notably, most of these people tend to work in outsourcing companies, and this is what's going to be happening in Germany. 500 being added in the west of Germany. They've already got some 700 in the capital, Berlin, working for a different outsourcing company. And it's notable, as you mentioned, Germany's real vehement hatred for this hate speech. They have really been very tough legislatively, as you were hearing, but this is all after the very sad backlash that arose after the immigration crisis that occurred in 2015, 2016, and you saw a lot of neo-Nazi sympathizers suddenly taking to social networks like Facebook to put their anti-immigration views across. This is why there is such focus to tackle this in Germany, notably as they got, of course, the key election about to happen in September.
David, what do you make of how Facebook is handling this issue now?
I think they're trying really hard to do the right thing. 7,500 sounds like a lot of people focused on this, but if there's 2 billion people on the platform, and let's face it, a good percentage of them, larger than we would like, are saying things periodically that are not very sociable, it's possibly going to take more than that. That's why they're also focusing very heavily on artificial intelligence as a way of surfacing the conversations and comments that maybe these 7,500 people ought to look at. I think focusing on Germany, though, is actually very smart for them because it is the country of all on the planet that is most sensitive to this issue, except maybe China for other reasons. And so I think they'll learn things there that they need to learn.
Caroline, are other countries going to be doing the same thing? Will we see this happening elsewhere?
I think this is really interesting. We have heard, particularly here in the United Kingdom and indeed in France, talk of potentially bringing in legislation themselves, fines themselves. Remember, this came after the terrible attacks that we saw in Manchester in the UK, in London, and of course the atrocities that we've seen occur over the past few years in Paris. Together, we saw France and the UK announce that they would be doing an anti-terror campaign. That was announced in June, and much of it was focused on, again, social networks on Facebook. In fact, Sheryl Sandberg, who we will be hearing from later with your interview, she came to the UK, spoke to Amber Rudd, who is the Home Secretary here, just a couple of months ago. And indeed, Amber Rudd's just been in Silicon Valley talking to the social networks and how they can crack down. But we've seen threats of legislation in UK and France. But really, it is Germany that has led the charge.
David, you know, social networks, Facebook, Google, they have thousands of workers around the world, not just dealing with now, hateful content, but offensive content, inappropriate content.
Suicide risk.
They have been criticized for outsourcing this work, some of the hardest work, to other countries where maybe employees don't have the same protections. What do you make of that?
I don't know. I have never been a big critic of outsourcing. I think jobs are jobs, and people, if they're capable, should be allowed to do the work. And I think the one question in this instance is, does Facebook have sufficient control and guidance capabilities over the people who technically work for outsourcing companies? But I suspect they probably do. Those people, in many cases, are extremely talented, very well trained. It's really hard work. It's the kind of work, honestly, that a lot of Americans don't want to do, because it involves looking at things over and over again, looking at pornographic photos or looking at awful things. They talk about the need to give these people psychological counseling just in order to do the work. So I don't criticize them for using outsourcing firms. I criticize them maybe for not having enough people and making fast enough action, but I think they're trying. They just need to try harder, and they know that.
Caroline, what do we know about the resources that these employees are given, and what sort of, counseling or, psychological help that they're also receiving?
Well, concrete evidence is pretty few and far between, Emily. But what is interesting, I went back to the post that announced all of this hiring in Germany today, and not once, not twice, but 3 times they mentioned the need for necessary support. They've clearly realised that there is this concern about, well, when people are basically staring into the abyss of human depravity, what sort of support can you give to these people from a psychological point of view? So they have spelled out time and again that they're going to be giving them counselling available. There is going to be plenty of training available. But as you say, these are people eventually hired by contractors. How much control will they actually have? The contractors are based in Germany. They will, of course, be working very closely in a network, it would seem. But it's hard to know exactly what sort of support systems these people will have. David?
Well, here's a point.
We only have 30 seconds.
Okay, this shows how serious the problem is. In Germany, just in the German language, they're now going to have 1,200 of their 7,500 people. Think of all the other languages that are happening around the world, and if they were to have a proportionate number of people working on this problem in every language, it would be probably hundreds of thousands.
Right. Bloomberg's Caroline Hyde and Techonomy CEO David Kirkpatrick there. Also out of Europe, tech giants from Alphabet to Facebook and Amazon have taken advantage of tax loopholes in the region, lowering costs and grabbing market share from local competitors. But speaking exclusively to Bloomberg's Caroline Connan, France Finance Minister Bruno Le Maire said the country is gearing up to propose new rules that could have big implications for the tech industry.
It's always the same strategy based on level playing fields, based on the same rules for everybody. When you are doing business in France or in Europe, you have to pay taxes. You cannot take the benefit of doing a business in France or in Europe without paying the taxes that other companies, French or European companies, are paying in Europe or in France. The same rules for all the companies and for all states.
Does that mean that you want to lower the corporate tax to 25% everywhere in the Eurozone?
We will lower the corporate tax from 33% to 25% till 2022. And then, this is the second step, we want to have a tax harmonization among the members of the Eurozone. You have 19 members of the Eurozone. You have one currency, the euro, and you have 19 levels of taxes, and you have 19 different economic policies. We cannot go this way anymore. That's why we are advocating for tax harmonization. The first step of the tax harmonization at the European level will be a tax harmonization between France and Germany. And I'm quite convinced that no later than 2018, we should be able, with Germany, to have a common corporate tax, which should be the basis for a harmonization of all corporate taxes at the level of the 19 member states of the Eurozone.
What concessions do you expect from the Germans in order to further this European integration? And in exchange, would you accept a German as the head of the ECB, for example?
Be a little bit patient. We are in 2017 and the decision must be taken in 2019. So it means that we still have some time before deciding who will be the next chair of the ECB. But we should not wait before taking decisions as far as the integration of the Eurozone is concerned. I really think that we should be able, at the end of 2017, to make a first step towards more integration within the Eurozone.
That was the French Economy and Finance Minister Bruno Le Maire in an exclusive interview with Bloomberg's Caroline Connan. Coming up, a move that is 20 years in the making. Why Netflix decided a comic book publisher was the right fit for its first acquisition. Next. And if you like Bloomberg News, check us out on the radio. You can now listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. David Letterman is making a return. He is teaming up with Netflix for a yet-to-be-named series that will feature in-depth interviews and in-the-field segments. There will be 6-hour-long episodes, which will premiere on Netflix next year. Letterman spent 33 years as a late-night talk show host and retired back in May of 2015. Now, Netflix has made its first acquisition, the streaming video company announcing it has snapped up Miller World, a comic book publisher behind characters and stories like Kingsman and Old Man Logan. The acquisition is Netflix's latest move to bolster its own content instead of just licensing it. This as rival media companies like Sony and Disney become wary of providing content to streaming services as popularity of sites like Netflix looms as a major threat. We discuss Netflix's next move with Bloomberg News reporter Lucas Shaw and Technalysis Research President Bob O'Donnell.
A big part of it coming off that Disney segment is because Disney, Time Warner, they already have these pipelines of comic book materials from which they can use. And right now, all of the TV shows and movies that Netflix offers on its service or at least most of them, are from Disney. They're TV shows that Marvel owns and produces. They're movies that Netflix licenses after they appear in theaters, and Netflix wants its own pipeline of original comic book materials that it can develop, it can own, it can exploit down the road if it wants to make T-shirts or lunchboxes or a theme park ride.
Bob, what's your take? Is this a smart deal?
I think it is, because I think what we're seeing is, you mentioned it, you mentioned Netflix as a media company, right? That's different than Netflix as a streaming company. And for them to become a media company, they have to buy and create this original content. If you want to create stickiness in your service, that's the kind of move you have to make. We see this with Amazon doing that for their Prime Video service, with Netflix doing this. I expect we'll see more of this. And I also expect that this is a bit of a challenge for a company like Apple, who's talked about doing this, because it's not clear what their commitment is there yet.
You know, it's interesting because when I spoke with Tim Cook after earnings last week, I asked him about their video and original content efforts, and he said, again, it's very, very experimental. You know, what do you think this means, Lucas, for other big media players and perhaps some unconventional players, a tech giant like Apple?
I think the traditional guys, you know, your Disney, Fox, Time Warner, CBS, Viacom, are very, you know, they're intrigued by this. They're not quite sure what to make of it. I had a couple of different people I spoke with today try to ask me to explain it. You know, Netflix has never bought anything before. As you said, this seems like a little bit of an outlier. It doesn't necessarily mean they're going to be out there buying a bunch of libraries, but it opens the door to that possibility. And it just reinforces that Netflix wants to be ready for a world where no one's going to license them a whole lot. You know, we've seen these big companies gradually retrench and revise their strategy because they felt like they were giving some of their most valuable IP away to let Netflix build its service. As for the new players, you know, we report obsessively on companies like Apple and Facebook and Google and what they're doing, but we've really reached a point where in terms of media creation, production, ownership, development, Netflix and Amazon are really on another plane from those companies. You know, Netflix and Amazon are making as much TV as the biggest media companies out there. They're streaming it all over the world. Apple and Facebook and those guys are still dipping their toes.
Hulu just had its first hit, The Handmaid's Tale, after many, many years of trying an original content. Does the fact that Amazon and Netflix, Bob, are so far ahead mean nobody else stands a chance?
No, I still think there's opportunity.
If they invest billions of dollars, well, certainly.
The content creation business is tough, right? I mean, there's decades of history of how difficult it is to make that a successful business, and it's a hard skill to acquire. And clearly, you're seeing a lot of efforts, a lot more of the tech industry, you know, marrying up with Hollywood and other places around the world, Bollywood, where have you, to try and come up with compelling original content. Because ultimately, as he said, you know, the notion of all of that content being given to Netflix for them to, not given, but licensed to Netflix to use, that may go away. So they have to be prepared if they want to survive long term as a media company, and we have to start thinking of them in that regard.
Bloomberg's Lucas Shaw and Technalysis Research President Bob O'Donnell there. And that does it for this edition of the Best of Bloomberg Technology. We will bring you all the latest in tech throughout the week. Tune in each day, 5 p.m. New York, 2 p.m. in San Francisco. And remember, all episodes of Bloomberg Technology are now live streaming on Twitter. Check us out at Bloomberg Tech TV weekdays. That is all for now. This is Bloomberg.